Thanks for clicking. Canadians are well positioned to wait out the storm. Wait out the downturn in the Canadian real estate market, according to a new report from Remax. According to the report, the amount of equity gained by Canadian homeowners over the past few years, especially relative to debt levels, have left Canadians better apt to deal with falling prices. So because Canadian home prices have gone up so much over the past few years, they'll be better off as the downturn unfolds, and fewer will find themselves underwater, where they owe more than their home is worth.
I think a modicum of gratitude would not be out of line here.
But regular viewers of this channel will remember that data from Remax is usually worthy of closer inspection. So what I want to do today is go over the report from Remax, take a look at how the brokerage is assessing decreasing risk, take a look at some of the glaring omissions, and then discuss what to look for next. Speaking of next, we are expecting January's real estate data to be coming out from the local boards any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report, the main argument being made by Remax, and the argument that is making the headlines, is that the loan-to-value of Canadian real estate, that is, the amount of debt held on a property relative to its value, has decreased significantly over the past 10 years. Given that Canadians owe less on homes that are worth more than they were in 2012, Remax argues they will be better able to withstand downward pressure on home prices. And by better able to withstand, Remax means better able to withstand downward pressure on home prices than Canadians were in 2012, 10 years ago, when, for the most part, loan-to-values were much, much higher, with Toronto's average LTV moving from 63% in 2012 down to 53% in 2022, London's from 80 to 59, Moncton's from 93 to 72, etc. So the LTV, the loan-to-value in general, was much higher 10 years ago than it is today. And as such, Remax is arguing that Canadians are much better prepared to deal with falling real estate prices. Yet there are a number of problems with the way Remax has packaged and delivered this data. First, it's not clear why Remax chose 2012 as its base year, as its year for comparison. It is clear, but we'll get to that. It's not clear what being better off than we were in 2012 tells us. If we look back to 2012, it was fairly unremarkable. Real GDP growth was up by 2%, inflation was running between 1 and 1.5%, and prime was sitting at 3%. 2012 and 2013, in terms of the real estate market and the economy in general, have almost nothing in common with 2022 and 2023. So it's not clear why Remax would choose that year to construct its data, and then say that we're better off now.
We found something that worked for me.
Indeed, instead of choosing some arbitrary year, why not look at pre-pandemic loan-to-value and then look at post-pandemic loan-to-value? Look at what the real estate market looked like prior to the ultra-low, near-zero interest rates and what it looks like thereafter.
Because it makes me look bad.
Did that era of ultra-low, near-zero interest rates raise or lower risks to Canada's housing market? Let's take a very brief look and see what that comparison would have shown. If we look at Toronto's housing market in February of 2020, the average price was $910,000 and the average mortgage amount was $436K. That's a 48% loan-to-value pre-pandemic compared to Remax's post-pandemic valuation of a 53% loan-to-value. So, on average, Toronto is worse off than it was before the era of low interest rates. If we look at Canada pre-pandemic, when in January the average home price was $504K and the average loan amount was $291,692, that's a loan-to-value amount of 58% pre-pandemic. Now let's take the average home price in the third quarter of 2022, which was $640,479, and the average loan amount was $363,000. We get a loan-to-value amount of 57%, or a 1% difference from the pre-pandemic. Hardly anything to write home about. So while we might be better off loan-to-value-wise than we were 10 years ago, we're not better off loan-to-value-wise than we were even 3 years ago. Remax picked an arbitrary year upon which to make its comparisons, and then made headlines by saying we're better off. But what about payments? Remax is making headlines saying that Canadians are better able to deal with downward prices, but it doesn't say anything about payments.
We really didn't think anyone would notice.
So let's take a look. Prime in 2012 was sitting at 3% versus the 6.7% that we have right now. And according to the Wayback Machine, going back to the third quarter of 2012, a decent variable rate was prime plus 0.2 or 3.2%. So let's take that average mortgage amount that Remax had in its base case in the third quarter of 2012. Let's use a 25-year amortization and a 3.2% interest, and we get a payment of $1,025 or $1,295 when we adjust for inflation. Now, let's use 2022's third quarter average mortgage amount of $363,654. We'll use prime minus 1 or 5.7, and we get a payment of $2,262. So, despite the headlines, the mortgage payments facing Canadians are no better than they were 10 years ago. In fact, they're much worse, they're much higher, they're much more burdensome. The loan to value is lower than it was 10 years ago, but it's not really lower than it was even 3 years ago. Nothing to write home about, especially given the higher payments. But a lower loan to value, even compared to 10 years ago, doesn't really help Canadians weather the storm. It doesn't help with payments. All a higher value does is help Canadians if they have to sell their home.
Not at all what I intended.
Should Canadians have to sell their home, then those homes won't be worth less than that which is owed. Hardly a comforting statistic, and I don't think many of those Canadians that will be selling their homes will consider that weathering the storm.
People will think what I tell them to think.
So, news at 11, Remax data isn't exactly matching its assertions, but I think the real news here, the real concern, is what the headlines are saying. Equity gone through the roof. Toronto and Vancouver have the best loan to value. Vancouver residents to withstand coming storm. None of these headlines allude to the fact that Remax is comparing 2022 to some arbitrary month in 2012, 10 years ago, and concluding that Canadians are better off, that they're better off to weather this storm. But when we take a closer look at that data, we see that although the values may be better, the loan to values may be a little bit better than they were 10 years ago. The payments certainly are not. And when it comes down to it, Canadians care about payments. Being able to sell your home and walk away with a little bit of money or not owe more money to the bank is great, but I don't think Canadians would consider that weathering the storm. I don't think Canadians would consider that being better off than they were in 2012, when they weren't losing their home and inflation wasn't at 6%. So, news at 11, data coming from Remax, not exactly trustworthy, but nonetheless make the headlines. With that said, we will be getting some actual data out from the real estate boards in the next couple of days, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.